Introduction. Just about every person is afraid of investing in the stock market. And since options trading is a part of the stock market, they don't bother learning about it. Some of them claim that trading on the stock market is a dynamic process that requires urgent solutions to make a lot of money, while other people think it's pure luck. Most of the time, people lose their money. You see, you get an option contract in options trading, and within the time frame of the contract, you have the choice of either buying, selling, handing over rights, or just holding on to them. This asset management gives you endless options that can potentially lead to more profits. And that's the underlying reason why smart investors chose to invest in options trading instead of buying the underlying stock. And of course, buying an option contract is much cheaper than the actual stock, bond, or product. And on top of that, they have to manage a number of shares at a lower price. Now that you have a strong introduction to the options trading space, let's get you behind the scenes so that you can learn how to exploit it to gain even more. To begin with, you will start by learning the difference between stocks and options and how they relate to each other. You can also understand the words used in trading options. Next, you'll be armed with various tactics that you can choose from time to time to maximize your position, as well as some do's and don'ts that you should keep in mind when trading options. These are just the basics, and I would suggest that you start by practicing options trading in fake environments. There are websites that allow you to practice this without losing real money. Or, if you feel bold enough, you can take on the real world of choices. Congratulations again on the purchase of this book. Now, let us begin. Part 1. What are options and how do they work? Chapter 1. The concept of options explained. Options are a common way of trading in the stock market because of their versatility. But this of course means that the investor should know his or her risk appetite to ensure that they do not lose more money than they can afford. Another explanation why it is appealing to most investors is that it gives the investor the ability to manage their position if the stock index changes. Since the 1970s, option markets have worked through major stock exchanges in many countries. In most cases, these markets have also seen substantial growth in both the number of options traded and the variety of options available. Why? Since options are a great trading instrument that can be used in a wide variety of strategies. Option strategies can differ in time frame, risk, and intent to meet the needs of a wide range of investors and traders. In this chapter, we're going to challenge what options are, how they function, and some of the several ways they can be used to increase your trading outcomes. In this book, we will apply the trading of traded options over stocks or bonds, unless otherwise stated. These are the options which can be purchased and sold via a central exchange, such as the Australian Securities Exchange, or ASX, and are the most widely traded option. This helps us to simplify the debate by incorporating the different components and characteristics of the choices. Options are also present over exchange-traded funds, or ETFs, indices, and currencies. There are also options provided by the firm which have different terms and conditions from the options traded. What are options? Options are just what their name suggests. They provide the customer with an option to buy or sell an underlying financial security. While this may sound restrictive, options are fantastic resources that can provide both an option seller and an option buyer with the potential to protect or hedge current stock positions, reduce their market risk, or produce additional revenue. Options can be issued on a variety of financial instruments, including commodities, indices, and foreign currency. In order to simplify the topic, we will, for the most part, apply to options for stocks. However, the same principles typically apply to options used in respect of other underlying financial securities. An option is specified by the contract between the provider of the option and the purchaser of the option. The contract gives the purchaser the right or option to purchase or sell a fixed amount of stock at a particular price on or before a specified date. In order to obtain this right, the buyer pays the seller a fee. If a purchaser chooses to use their option, this is referred to as exercise their option. When the option holder exercises its option, action is taken to purchase or sell the stock as stated in the option contract. The owner of the option is referred to as the purchaser because they have the right to purchase or sell the underlying stock. The seller of the option gives the buyer the right to purchase or sell the underlying stock. The seller has no power over whether or not the option they have sold will be exercised. They also established a duty to execute an option contract if the purchaser wishes to exercise the option. The provider of the option shall be referred to as a writer, as underwriting or accepting the duty inherent in the option. In layman's words, an option is an arrangement whereby the seller has the right to exchange, the freedom to buy or sell, the underlying commodity at a fixed price at a specific date. What this means is that you predetermine the price of the stock you intend to buy, regardless of the variations that arise over the course of your contract. Commonly, one option contract is equivalent to 100 shares of the company. The appealing part of the options contract is that it binds the buyer and seller to a contract with strict properties and conditions to minimize the possibility of loss. Imagine, for example, that I want to buy McDonald's stock, also known as NYSE MCD, sometime later. The current stock price is $101 per share, and on the basis of their current position, they are doing pretty well, and the stock prices are expected to rise in the near future. So I decide to have a call option. This is a form of option contract that we will discuss later in the book, and I get the right to buy McDonald's stock at $101. I plan to buy 10 stocks at $101 per stock in exactly 60 days from now. Now that I've got a deal, I can wait. Fast forward to 55 days later, and I see a rise in the stock prices. Now it's $200 per share. But since I had an options contract to buy 10 McDonald's stock shares at $101 each, I could get it on a steal. This is the ideal case. Consider a situation where the price is dropping. Remember that instead of rising prices, McDonald's stocks are dropping to $50 a share. In this scenario, my options contract would mean a loss to me. And in no way would I buy the stock at $101 if the market price was $50 per share. In this case, I let the option contract expire and instead buy the stock at $50 per share. And this is it. This is all of it. The truth is, you've been trading for a long time without even knowing it. Think of the moment you purchased your auto insurance. It's close to selling stocks. When you bought your car, you got an insurance policy along with it, just in case anything happens. During that time, you didn't know how much the repairs would cost, nor did you know the price of the car as time goes by. The price can increase, of course, but the insurance will help you cover yourself just in case. Trading options is exactly the same way. This is a way to give you the right to buy a stock at a fixed cost, and if the price does not rise according to your choice, you can cancel the contract and then purchase the stock in that company. Calling options. Call options offer the purchaser the right, but not the obligation, to purchase the underlying stock at a fixed price on or before the specified date or expiry date. The price defined in your options contract shall be referred to as the strike price or the exercise price. As a purchaser of call options, you are looking for an increase in the value of the underlying stock. An increase in the cost of the underlying stock can lead to an increase in the value of your options. The vendor of the call options shall be granted a premium for accepting the duty to sell the underlying stock to the buyer of the options at the strike price if the purchaser chooses to exercise the option before the expiry date. If the purchaser exercises the option, the seller must sell the underlying stock to the purchaser at the price of the strike. If the buyer doesn't exercise the option, the seller merely maintains the premium and the obligation stops with the option on the date of expiry. Put options. Put options offer the investor the right, but not the obligation, to sell the underlying stock at the specified price, increased price, on or before the expiry date. As a buyer of a given option, you are hoping that the value of the underlying stock will decline, as this will result in an increase in the value of your options. The seller of a given option earns a fee for giving the right to the purchaser. If the option is exercised, the option seller must purchase the underlying stock at the strike price. Option contracts. Optional traded options contracts include standard terms and conditions. Each option contract defines the following four components for any traded exchange option: underlying security, the size of the contract, day of expiry, the exercise price, or the price of the strike. The option premium is not part of the contractual terms of the option contract, since the option premium is unpredictable and is largely determined by the market value of underlying security and the time left to expire. List of pricing choices. Exchange-traded options are listed on the stock exchange in the same way as many shares listed on the stock exchange. Options are shown as a code of 5 or 6 characters. The first 3 letters of the code are the same as the code for the stock. The 4th and 5th letters are used to denote the month of expiry and the sequence of choices. Occasionally, if necessary, the options will have 6 letters. For example, Woolworths Limited is listed as WOW code on the ASX. Options that have Woolworths Limited as the underlying stock will have codes like WOWXA. Options versus shares. Investors in the stock market purchase a number of shares in a specific company. It's a tangible commodity. The shares they have acquired constitute a shareholding in the company, which is measured by the net assets owned by the company. You are in charge of your investment when you buy shares in a company. You can determine how long you want to keep those shares and when you want to sell them, and you can specify the price at which you want to sell them. Although there is no assurance that the seller will pay the price you ask for, you will have the right to collect dividends from the stock, and most of the shares grant the owner the right to vote at the shareholders' meeting. Options, on the other hand, is an intangible commodity. They are not reflected by any underlying physical properties. The holder of the option does not hold an ownership stake in the underlying stock. The probability is essentially a contractual right to take action. Consequently, the value of the option is just a fraction of the price of the underlying stock. As a buyer of options, you also have a finite period of time in which your right remains. Note that we have defined an option as a contract that gives the purchaser the right, or option, to purchase or sell a fixed amount of stock at a certain price on or before a certain date, the expiry date. As a result, the option ceases to exist at the close of trading on the expiry day or the date on which you exercise the option. So, the option buyer has purchased an asset that has a limited life. If it is not exercised or sold before the expiry date, the option ceases to exist and expires without benefit. Option consumers are also faced with a further restriction. The choice contract specifies the price at which the option can be exercised. Unlike stocks, where you can determine at what price you want to sell, options do not have that versatility. The option contract defines the price at which you can exercise the option, the strike price, and thus the price at which you can purchase or sell the underlying stock is preset. We will present the pricing principle here only to demonstrate how an intangible asset can hold value, and in particular, how an intangible asset that will be worthless at expiration can hold value. Pricing option. The premium price, or value, of the option is calculated mainly by two factors: the intrinsic value and the time value of the option. The intrinsic value is determined by the difference between the selling price of the underlying stock and the price at which the option can be exercised, or the strike price. If you own an option to purchase a stock at $20 and the current market price of the stock is $22, then you'd expect your option to be worth $2. The inherent value of the option exists because the option offers you the right to purchase the stock for $2 less than the actual market value of the stock. The second aspect of the option price is the value of time. This is the value given to the probability that the market will shift to your benefit over the life of the option, and that you will make a profit on your option. Time value is calculated mainly by the amount of time left on the option before it expires. As such, the time value decreases the closer we get to the expiry date. Upon expiry, the time value will be 0. In essence, therefore, the value of the option is determined by the difference in the strike price and the market price of the underlying stock, plus a value that reflects the potential for the market to move in your favor before the expiry date of the option. Option sellers. Another important distinction between shares and options is that of the seller, or the author of the contract. When selling shares, after the seller agrees on the deal, he or she has no other responsibilities or rights with respect to those shares. However, they received a fee in exchange for underwriting on the duty to satisfy an option contract. If the purchaser chooses to exercise the option, the seller must sell the underlying shares at the strike price to the option holder. If the purchaser chooses to exercise the option, the seller must purchase the underlying securities from the option holder at the strike price. Why do you need to learn options? Remember what Warren Buffett said: never depend on a single source of income. And with the aid of trading options, you can diversify your investment and increase your overall investment portfolio. This could surprise you, but options are being used by major companies around the world as a hedge strategy to shield themselves from the risk of losing a lot of money when stock prices unexpectedly begin to fluctuate dramatically. Forex fluctuations are a clear example of this. If you work in a big company, you could also be given an option contract if you are one of their best employees. To cut to the chase, selling options gives you leverage in the trading environment and also allows you to make a bigger payout for yourself when you decide to sell the stock. The best part of this is risk control. If you're a new investor, you should think less about your portfolio being spoiled, because with options trading, it can only look better. Options difficulty level. Most brokers will warn you against selling options. They're going to say that it's not for everybody because the chance of losing money is massive. But the fact is, if you have adequate understanding of the underlying asset and you're able to handle the risk you're taking, you can reap significant benefits from it. One should note that a lack of information about trading means losing money. Just like any investment, you need to think about various tactics and situations and what you need to do in these scenarios to come out with a smile on the other side. This may sound like a tedious job for you, but once you learn how to make a living, you'll be inspired to learn more, because then you'll know that information helps you make a massive amount of money. But one thing you should bear in mind is that you should start slowly and build a solid base. In this chapter, you will learn the fundamentals of trading options, and as you continue, you will learn all the nitty-gritty information that you should consider making a profit. Summary of chapter. Options provide the purchaser with the right, but not the duty, to purchase or sell the underlying security. Options can be issued on a wide variety of securities, including commodities, indices, and currencies. Options are specified by the contract specifying the underlying security, the strike price, the expiry date, and the size of the contract. The purchaser shall pay the option fee to the seller. The seller of the option has given the buyer the right to purchase or sell the underlying security. They also have a duty to comply with the terms of the option if the purchaser wishes to exercise the option. Options are classified in two key types: call options and set options. Call options give the purchaser the right to purchase the underlying security at the strike price at any point up to the expiry date. Setting options give the purchaser the right to sell the underlying security at the strike price at any time prior to the expiry date. Exchange options have uniform terms that include the underlying security, the duration of the contract, the expiry date, and the strike price. Options are intangible assets, since an option is a right that does not reflect the ownership of any underlying physical assets. Options have a fixed lifespan and cease to exist at expiration. Options are very flexible and versatile trading instruments that can be used in a wide range of trading strategies. Certain option strategies may entail a high degree of risk, while other options may reduce the investment risk. Chapter 2A. Why consider trading options? This is a common question people are asking. Why do you want to exchange options? Well, the first reason for this is to protect and control your risk. If you take a big risk, trading options is the way to protect yourself so that you don't lose all your money. It gives you full control of how and where your money is going. But one thing you should know is that trading options should not be done with your eyes closed. You're going to have to keep an eye on the market, and if you don't, it's going to shoot you back. There are a few ways to exchange options, and you'll learn all of them in this chapter. Let's get started now. Hedge and speculation. Hedging and speculation are the first two things you should learn before you spend a single penny in trading options. This is what's going to get you going and how you're expected to handle trading options. Hedging is used when you feel like something could go wrong. It doesn't mean that anything is going to go wrong. It's just a way to protect yourself. Your money, if things do start to go wrong. Hedging is the way to ensure your investment if rates start to fall. In other words, hedging is your defense against losing a lot of money. Hedging is used by large companies and institutional investors to cover themselves. On the other hand, if you have no knowledge of the underlying asset, the stock, bond, or commodity, when using options as a hedging strategy, then, according to experts, you would certainly lose money. This is because you're trying to hedge too much to buy premiums on something you don't know about. This means that instead of taking a gamble and growing your income, you're going to lose your insurance money. However, if done properly, hedging is the perfect way to shield yourself from failure. Next is speculation, but this is very dangerous. There are 3 ways that any investor makes a profit: when the price goes up, when the price goes down, and when the price moves sideways, meaning that the price stays or goes up and down within the range. A lot of money can be made from speculation. Speculation may be rendered by researching and analyzing the market. This includes assessing and forecasting patterns and finding out where the market is heading from the present point of view. This can be a big advantage if you're familiar with the market and have good knowledge of the underlying asset. But as I said before, speculation is very risky. An investor who wants to make a profit as a speculator must be able to correctly predict the trajectory of the asset price, or whether it will rise or fall, the timing of that direction, and the magnitude, or by what amount the price will change. Advantages and drawbacks in trading options. We do accept that selling options is difficult. But once you grasp it, it's going to be an ability that you know like the back of your hand. The best part of options trading is that you can make a profit from the price change of the underlying asset without directly investing in the asset. As I mentioned earlier, investing in options is actually cheaper than investing in the actual asset. Plus, if you invest directly in the asset, you will have less leverage. In short, by selling options, you now have access to more money than you would have had initially. And if you add it up, leverage, capital, and so on, you can find that an investor will potentially make more money per actual dollar invested compared to investing directly in the asset. Often with options, an investor can only lose a fixed sum of money, which is effectively the premium he or she has paid. This means that if you don't place anything in the premium, you're not going to lose everything. This is the safest thing to do if you're just trying to test the water and you're not ready to go all in. Another great benefit of options trading is that you can use hedging as an insurance strategy to shield yourself from losses that are getting too large. This ensures that you can also shield yourself from extreme swings in the stock market. I would strongly recommend that you begin with as much hedging as possible to reduce your losses. Another advantage is that you can make money even if the stock doesn't make money. It's because of the ability to trade up, down, or sideways to maximize your power and income. You'll see the stock price dropping several times, and you can still make a profit at the end of it. Plus, commissions are much less active in trading options. Now you know why stockbrokers are advising you about it. And if you want to go through an online broker, those commissions are even smaller because they want to beat their competition. In addition, trading options is flexible. It helps you to respond based on where the price is going. It gives you the freedom to participate in more than one business as well. This means that you can invest in everything from agriculture to foreign currency. Plus, you don't have to spend a lot of money like large companies. All you need is a minimum sum, and you can start making money. Last but not least, and this one is a biggie, the pace of having your profit in hand. Yeah, as soon as the stock increases, you'll get your benefit so that you can start investing in other markets or stocks. The pace of the market helps you to invest in more markets at the same time and make more money out of it. And unlike other forms of day trading, options trading is just a short-term bet. This means even if you make an inaccurate prediction, you'll lose money within a few months instead of waiting for years to lose money because of that error. Taxes are a detriment when it comes to trading options. Yeah, you're going to have to pay taxes on everything you do, except in those exceptional situations. So make sure you fill out your IRA form to make sure you keep tax tabs before you start investing. Moreover, unlike shares, there is no certificate of deposit when it comes to options. It's all paying rights, so it doesn't give you evidence of possession. This means that you will not be able to justify to people the ownership of the stock unless it is a stock certificate. That's why most investors make sure they have an in-depth, detailed knowledge of what they're investing in, because it can quickly turn into a gamble that isn't worth the winnings. It's important to know your plan, and be sure to start small and slow in order to prevent losing high. It's almost like driving a car. It's all scary when you're driving for the first time, but as you spend more and more time behind the wheel, you know the tricks of the trade, and you instantly become the best driver. Chapter 2b. Options and their characteristics. Parties to trading options. There are 4 types of participants involved in the trade of options, and as common sense implies, buyers and sellers of a particular stock or product are at hand. Holders are the ones that have the justification for a choice. You're not allowed to confuse yourself with the words here, though they're easy to understand. One thing you should always note is that when you have an option, you have the right to buy or sell the underlying stock. For example, if you have an MCD call option, you have the right to buy the option at a certain price. And if you have a put option for the same stock, you have the right to sell it at a certain price. Authors, on the other hand, are the opposite of holders. They're the ones that sell an option deal. It's compulsory for the writer to have the underlying stock or to have the cash ready to buy the underlying stock at a moment's notice. So, for example, if you write an MCD option and decide on the options form, put or call, the stock price, the expiry date, and the premium, we'll cover that later, you're going to give out the right to buy or sell the underlying stock you've arranged. In either a put or a call option, the investors are not obligated to purchase or sell the underlying asset until the contract expires. However, this is entirely different for the authors. They are obligated to comply with the terms of the contract. The call options. In the call option, the holder of the option can purchase the underlying asset at the agreed date and price. However, the holder expects the price of the asset to increase over that period of time. But with this, you should be very careful. And if you, as a holder, buy an asset at an elevated price and go along with it, you might end up losing everything. You should note that once you buy the asset, there's no limit to how much you can lose. So if your loss continues to increase, your losses will continue to increase. You should understand that sometimes the market is unpredictable, and you might go from getting everything to losing everything in a moment. The put option. In a given option, the option holder can sell the asset at an agreed price within a certain period of time. A put option is the same as short on stock, which means that you expect the price to fall. This means that if the price of the stock falls before the contract ends, you will make a profit. This can be a good idea if you know that stock prices would fall after rising. However, you should also realize that there is a risk that it could be plateau and not fall at all until after your contract expires. The best aspect of a put option is that when the price drops, you can still make a lot of profit. But when things are going against you, you're not going to lose money. So, if you want to rapidly turn loss into gains without having to hold the underlying asset for a longer period of time, having the option package is the way to go. Many investors are waiting for stock prices to fall so they can make a move. This is because falling prices put them in a leveraging role. Options variations. There are option contracts that can be held for several years for long-term holders. This is somewhat close to conventional trading on the stock exchange, where the investor invests directly in the underlying asset. A simple choice is a simple put or call option, while an exotic alternative can be an easy option or an entirely different option. Transacting or closing trade option. The truth is that most of the options are neither purchased nor sold before the contract expires. A lot of investors actually do not make use of their options. Occasionally, option holders sell off their option contracts while other authors buy back or hold on to their own options. Almost 60% of the options have been closed or sold, while 30% have expired and become worthless. In fact, only 10% of all options are being exercised. And that's alright, because there are occasions when the value of the option itself will prove to be lucrative enough for you to trade away. Pricing options. Options are priced on the basis of the premium measured for them. The option premium is simply the inherent value of the option plus its duration-based time value. The easiest way to explain this is to compare it to the insurance premium, which is what you pay for the option. For options trading, this is what you're paying for the option you're buying and the stock you're going to get. We're going to discuss this in later chapters. Chapter 3. Comparing options versus stocks. You should always take note that an option is just a contract. The holder of the option has the right to purchase or sell the underlying asset at a fixed price before the expiration of the contract. Most of the time, an asset is selected as the underlying asset of an option. But there are other assets from which you can make money through options, such as stocks, foreign currencies, government securities, exchange-traded funds, and stock indices. Usually, the stock option is equal to 100 shares in the stock of a particular company. Here are a few items that the options contract must have: the expiry date, the strike price, a number of shares or quantity of commodities, the underlying asset, and type of the option, put or call along with any variants. As we pointed out at the outset, the reason why stock options are favored is because of their low risk and high leverage. An investor will only lose up to the total amount he or she has paid for the option contract premium. This is because the options contract has an expiry date. Yet there are two sides to the coin. The customer can just sacrifice the premium he has paid. On the other hand, the same is not the case with the seller. A stock option allows the seller to predetermine the price for a certain period of time. It's comparatively cheaper than buying the stock. In addition, an investor can make more money from options trading by leveraging. Examples of options and leveraging. Imagine that an investor bought 100 shares of a single company's stock at $100 each, which ended up costing him $10,000. Besides the stock, it also has 5 $200 premium call options, each with a $100 share strike price, which will give it the right to buy 500 shares as well. Let's say the share price rose to $110 a month later. This will result in a profit of $1,000. What if the option premium for the same stock is also raised to $300 for each contract? For daily stock investment, the gain is 10%. For its stock option value, the gain is 50%. But if he decides to use all 5 options by buying 500 more shares at $50,000 and then selling them at $55,000, that would net him a profit of $5,000. But then again, there are drawbacks to leveraging too. If the price did not shift in the right direction, the percentage loss would be raised. Using the same example, if the share price dropped to $80, $10 lower than the option strike price, the loss would be 20%. On the other hand, the option premium could fall to $80, resulting in a total loss of 60%. That's why investors need to use their leverage prudently when trading options. They should also have a strong demand outlook before investing in it. Plus, they should also be continually looking at the business they are investing in to see how their earnings are going to be made. Time frame. There is no expiry date for a daily stock. What this means is that a shareholder will retain his stocks forever. On the other hand, stock options have a fixed expiry date, and an option becomes useless only if it is not exercised before its expiry date. Ownership. The ownership of the share of the stock is verified by a certificate issued by the company. However, the stock option does not have a certificate of ownership. It's just an arrangement, and whoever keeps it, he owns it. For options, though, there are no papers. You're just going to get the option. Volume. Only a fixed number of shares may be issued by a corporation. As a result, investors can exchange only a limited number of shares. There are normally 100 shares for each stock option. On the other hand, there is no limit to the number of stock options that investors can purchase or sell. However, if the option is not exercised, the stock option does not give dividends, voting rights, or the ownership of the company. Market exchange. Skilled traders, individual investors, and institutions can trade options on an exchange of options. It is possible for an individual to conclude a number of options contracts at the same time. Like standard stocks, stock options are exchanged on the market controlled by SEC. Brokers are facilitating options trades much like normal stocks. Monitoring transactions and results are easily carried out in their respective marketplaces. Part 2. Some of the relevant words. Chapter 4. Note these terms of options. Strike price. The strike price is the value of the underlying asset that can be sold or purchased if an investor exercises the option. This affects the viability of the option and is a primary determinant of the option premium when it comes to how long it is going to take. This implies that if the underlying asset is a stock, and if it is a call option, the stock price must be higher than the strike price in order to make a profit. If this is the put option, the stock price must be lower than the strike price in order to produce profit. The option cannot be exercised if the conditions are not met before the contract expires. The option listed is traded on an exchange of options, such as the CBOE or the Chicago Board Options Exchange. It has a set expiry date and a strike price. Listed option. Here, the listed option referred to is equal to 100 shares of the stock. The call option is in the money, meaning it is profitable, if the market price of the underlying asset itself is higher than the strike price. On the other side, a put option is in the money if the price of the commodity is lower than the strike price. An inherent value is the sum by which the option has become in the money. Premium. The premium refers to the total price of the option. Factors that influence the premium include the uncertainty, time value, strike price, and price of the underlying asset. It is normally difficult to measure the premium option, but not with a good pricing model to adopt. More on this in a later chapter. However, the premium is always the intrinsic value of the asset plus the time value of the asset. It's essentially the price that the option buyer has to pay the option seller when they purchase the option. It is the risk that is associated with it, and it can be a small amount or a large amount. The market volatility is also measured, and if the stock carries a higher risk, the premium will rise. This is similar to insurance, and if there is a greater risk because you have been in an accident before, or have had several medical conditions, the premium would rise as a result. The intrinsic value is known as the in-the-money amount or the strike price if it is a call option. Time value, on the other hand, is likely to increase the value of the option. For example, if the premium is $9.25, the intrinsic value could be $9, while the time value is 25 cents. In most cases, options are sold more than their intrinsic value. Conversion. A conversion is created when a call option is offered, a put option is acquired, or at least two options have the same expiry and strike price. This is usually done when the options are overpriced relative to the current stock. Doing this helps you to make a risk-free benefit as a result, and if you see anything like this, you can take advantage of it. A delta is a reduction in the price of an option, and an exercise is a decision to execute the option provided for in the contract. This is widely used as the economy changes and prices change. The expiry date is the date on which the contract is terminated. This means that the option is no longer available and no longer valid. The grantor is an individual or person who is prepared to exercise the option before the contract expires. The stock option expires on the third Friday of the month of expiry. Intrinsic value. An inherent value is the price of an option upon immediate exercise. An option is said to be out of the money because it has inherent value. A strangle is a situation involving the purchasing of both call and put options with different strike prices but identical expiration. The time value is a portion of the premium that exceeds the inherent value of the premium. Underlying asset. A type of protection that the option seller has is the underlying asset. It is the duty to make the purchase from the option holder in the event that the option is exercised. In this case, there are certain shares in a particular company. These options are typically also available in currencies, indices, and commodities. These simple terms are what you need to know when it comes to experiencing stock market trading options. Knowing these simple words can start you on the right path to success. Chapter 5. Pricing and Trading Options. A lot of people find it difficult to grasp trading options, and this is mostly because it is difficult to comprehend all of its pieces. However, once people understand the science behind trading options, they will finally use their art form to achieve their investment goals. The price of an option is highly dependent on the price of the underlying asset, the volatility of the asset, as well as the remaining period of time before the contract expires. This chapter will look at how the price and exchange of an option works and what it means at its heart. Price of the asset. At its heart, the price of the underlying commodity is essential in the pricing of options. It's what it's all focused on. It's the price of the asset. It's what the put and the call options are going to be shaped around, and it's what you're going to look at to invest in. Essentially, as asset prices rise, call option prices also increase. The put option rates, however, start to drop. On the other hand, if the price of the commodity falls, the reverse happens. The put option prices start rising, and the call option prices start falling. This is to ensure that whatever way it goes, the put and call options also go. If the asset is only necessary for a short period of time, it is normal for people to exercise the option. But if the asset has potential, it can also have a call option. Since options expire, time is critical for option pricing. The longer the expiry period, the higher the price of the option. As time passes towards the expiration, the price of an option decreases. That's why it's important to see the immediate benefits from it, because the option price can decrease over time, and you may never again get the stock for that price. Volatility. Volatility is also a factor in the pricing of options. In the case of options, those which are stable have lower option rates than those which are highly volatile. There is also such a thing as implicit volatility, which is based on the assumption of the market maker. If a lot of people invest in a specific stock, the price will increase. The market maker will change the implicit volatility to raise the option premium. As a flexible investment, a cheaper alternative to a stock is an option. Trading options will bring more gains through leveraging. It also decreases the overall risk. You're not going to put all your money into one thing, hoping it won't fall. Plus, since the option is only available until the expiry date, your money won't be tied up forever. Only up to the option premium will an investor lose money. Mainly, what they paid for the option in the first place. If there is a call, they would not lose anything other than the premium, which may be a small price to pay in the case of a stock. Margin requirements are, therefore, not necessary if the investor wants to purchase an option. On the other hand, the author's option must purchase or sell the underlying asset if the holder has exercised his option. An option writer could keep the premium money paid by the option holder, but only if the holder failed to purchase or sell the underlying asset before the contract expires. As such, there is a need for a margin on the part of the writer. Theoretical value of an option. The potential value is different from the option premium. As discussed above, the option premium is charged by the next option holder, so that he or she can purchase or sell the underlying asset before the expiration of the option contract. The potential value is merely an approximation of the present value of the option. It is determined on the basis of the formula of the chosen pricing model. It involves variables such as the timing before expiry, the strike price, and the price of the underlying asset. As these variables change over the life of the contract, the theoretical value constantly fluctuates before the option expires. A theoretical value is created by an option pricing model. Every factor has a certain value and is part of a theoretical value of the future. If the stock is selected as the underlying asset, its theoretical value requires implicit volatility, which is dependent on the supply and demand of the option. An investor uses various pricing models to know the theoretical value of the option. Variables, such as implicit volatility, timing, strike price, and the underlying asset prices, are all part of the computation. The potential meaning changes over time, as these variables often shift. Many investors and traders use this theoretical value to know the value and risk of the option in order to make an informed decision. Trading sites now deliver modified prices, although price calculators can also be used online. Using a quantitative formula to decide how much you can theoretically take off an option or stock is crucial before you start. Using this formula will help give you a clear understanding of what you're going to get out of this, and it will help you decide whether or not investing in this choice is worth it. Knowing the fundamentals of how stocks operate, the properties, and what happens to them, you will control the market to get the most out of the money you put in it. Chapter 6. Options Pricing Models. Here are a few pricing models to adopt when trying to find out the price of an option. All you have to do is thoroughly understand a few good templates and then use an online calculator. This chapter will cover some of the basic models out there along with how you can understand them. Model of the Black-Scholes. In 1973, Robert Merton, Myron Patty, and Fisher Black developed the Black-Scholes pricing model as a means of premium computing options. This model has been the most famous since then. In reality, Merton and Patty won the Nobel Prize in Economics 2 years after Black died in 1995. Black, however, was still remembered for his role, although he was not awarded the Nobel Prize simply because the Nobel Prize is only awarded to living persons. The Black-Scholes model applies only to European options, both put and call, and does not include paid dividends in its estimation. However, the use of the ex-dividend value of the asset can also be used. The model assumes that the option can only be exercised when it expires, and that's why only European options are being considered. Moreover, apart from not accepting paid dividends, this model also does not take into account any commissions. It also implies that the market is effective, and that market fluctuations are not predictable. Volatility and risk-free interest rates are stable and well known. Finally, the Black-Scholes model assumes that returns are normally distributed. This option only takes into account one risky asset, such as a stock, and then a risk-free asset, such as cash. There is no possibility of arbitration for this, but there is a way for someone to borrow money at a risk-free rate with this model. You can also purchase any stock with this model, even a fraction of it, without any secret fees or costs. With this option, the derivatives are calculated at the present time, as well as the payoff. You can make a long stock investment with a short investment option. In order to determine the option value, the Black-Scholes model includes the following: risk-free interest rates, time expressed as a percentage of the year, the strike price, and the current price of the underlying asset. The formula for these mathematics is complex. The average person will be frightened by using it. Luckily, online calculators are available that can be used to measure the price using this model. In addition, there are analytical instruments offered by trading platforms that are used to determine the price. This is a decent way to get an investment approximation, but it's not the only way you're supposed to be depending on. Owing to market volatility, liquidity threats, and unexpected shifts and risks, you could be exposed to some really big risks. There are also extreme price shifts, and much of the time, money doesn't come with an unchanging value in the real world. This is a good way to get a sense of what you're about to do, but at the same time, you're not supposed to rely on that. Cox-Rubinstein Binomial Option Price Model. The version of the Black-Scholes model, the Cox-Ross-Rubinstein model, was developed by Mark Edward Rubinstein, Stephen Ross, and Carrington Cox. The primary advantage of this approach is that it uses a lattice-based model which takes into account the price fluctuations of the underlying asset over time. The lattice-based model takes into account changes in various variables over the existence of the option. As a result, the price of the option is more accurate. It looks like a tree and progresses to the expiration of the stock in this way. This model is being used for American options. It assumes that everyone is oblivious to risk, so that returns are equal to a risk-free interest rate. The Cox-Ross-Rubinstein model often suggests that arbitration is not feasible because the market is perfectly efficient. The price of the underlying asset will never rise and fall at the same time. At any given time, it can only go in one direction. During the life of the option, different time points may be defined. It is also possible to establish a binomial tree. Normally, this is determined from the beginning of the option to the end of an option, and then back again. When this has been achieved, it will be measured on the basis of the parameters of the changes in dividend rates, along with the changes in option prices. All of this is measured together and put into a statistical model to help others understand where their money is going. The greatest advantage of this is that it works with American stocks. Another advantage is that it also allows you to see exactly where the stock is at a given stage. You can take a look at this, and through the analytical properties of this stock, you'll know where it will be in the future. In that respect, it's beneficial. The greatest drawback, however, is that it will take forever to calculate. you're looking at a lot of numbers all at the same time, and many older machines just can't do it. However, with the advances in technology, software is able to keep up with the pace of changing numbers. It's a smart idea to get an online calculator to see where the stock will be at a certain point in time. Like the Cox-Ross-Rubinstein model, online pricing calculators and analytics tools offered by trading platforms can be used to know the option price. The parity of put and call. The put and call parity was introduced by Hans Stoll in 1969 as a pricing principle. According to his report, there is a connection between a European call and put options with a similar strike price and expiry date. This means that for each call option value at a specific strike price, there is an appropriate put option value for that call option. The same goes for the fixed value of the option. There is an acceptable call option value for the specified put option value at a particular strike price. The relationship occurs because a position is formed, which is the same position as the underlying asset when there is a combination of call and call options. The returns must be identical to the underlying asset and the option such that the arbitrage does not occur. Traders and investors who take advantage of arbitration can make a profit if the opportunity occurs. The put and call parity is used to assess pricing models for European options. If the outcome of the pricing model does not satisfy a parity check, this means the arbitration will take place, and the model must be rejected as a pricing strategy. There are a variety of ways to measure the put and call parity. Luckily, several trading platforms offer analytics software. These include visualizations of parity between put and call. But of course, you don't have to memorize all the pricing models in full. Only choose one that suits your situation, have a simple online pricing model calculator, and then let the numbers shift for you. Part 3. Let's start investing. Bonus chapter. Employee stock options. Although not very popular, some employers use the employee stock option to encourage the best workers to work in their business. It's used to prevent promising workers and great talents from leaving the company. This choice is exactly the same as other stock options. The employee can purchase the company's stock, but he or she has no obligation to do so. The employee stock option shall bind the employee and the employer to the details of the contract. On the other hand, the usual option binds two separate parties to the deal. Employees can also invest in options. However, not all workers have the ability to do so, since they are typically given to the best employees by the employer. However, not all employers are selling stock options. However, if it is handled correctly, it can be a lucrative investment. When an employee is given a stock option, the employee should ensure that he or she knows the ins and outs of the stock option, with a view to generating the full value. It is important for workers with stock options to consider how this affects their personal income. Employees must also consider the scope and nature of the taxation of stock options. An employee can purchase a preset number of company shares at a predetermined price within a given period of time. Types of employee stock options. A stock option can be listed as an incentive or non-qualified. Employers are given a non-qualified stock option to consultants, outside directors, and non-management staff. There is no special tax treatment for a non-qualified alternative. Incentive stock options, on the other hand, are strictly given to the executives of the company. Incentive stock options have a preferential federal tax status, as they qualify for some terms of the Internal Revenue Code. Both stock options are difficult to enforce, since they must meet the strict rules laid down by the employer and the IRS. Exercise timing. At the beginning, employees do not completely own stock options. They've got to follow the DRESS plan. The schedule begins on the day that the options are granted. The employees can exercise the options on certain dates depending on the terms of the contract. In most cases, only a number of shares can be held on a vesting date. At the end of the deal, workers can no longer purchase the shares of the company. The exercise price is the amount of money that workers would have to pay for the share of the company's stock. It is also the basis for the estimation of the tax payable and the gain. The benefit is measured as the difference between the market price and the exercise price. Taxation. A non-qualified employee stock option is taxed when exercised. The benefit shall be regarded as compensation and shall form part of the taxable income. If the shares are sold immediately by the employee, this will be a short-term capital gain that will be taxed at normal income tax rates. If the shares are sold after 1 year, they will be part of the long-term capital gain, and the tax due will be reduced. An incentive employee stock option is not taxable when exercised. However, the benefit could be an alternative minimum number. If the employee sells the shares within 1 year of the exercise of the options, the benefit shall form part of the ordinary profits. The benefit shall be regarded as a long-term capital gain if the shares are retained for at least 1 year after exercise and sold at least 2 years after the date of the grant. Chapter 7. The Process. Now that you know the rules of how to buy stock options, it's time to learn how to do that. Stock options buying may seem like an insane ordeal, but the truth is, it isn't. This chapter will go through the process of buying stock options and what to do when you do so. Remember, investors need to understand that when they purchase options, they are only taking advantage of the profit opportunity within a certain time frame. They're not buying the stock themselves. Recall that the call option gives the investor only the right to purchase a fixed number of shares of the underlying asset at a strike price, as long as it is not yet expired. A put option, on the other hand, is only the right to sell a fixed number of shares of the asset at a specified price within a certain period of time. It can sound repetitive, but it's crucial for beginners to understand the difference between the two. The investor must first settle on the type of underlying asset to be invested in. He or she must also decide the price direction of the asset. This is where you're supposed to be looking first. It's key to find out what to invest in. You have to do a lot of study of the market at hand to see the patterns that are going on with the stock. If the stock isn't doing well, don't try to invest in it. Instead, move on to something else that has a greater chance of being good. You can also start with items that are not volatile. In a volatile stock, it might go from big to bad within a day or so. These types of stocks are hard to manage, and they could set you up for losses. Instead, start with a stock option that is less risky, but also has a chance of being lucrative if you do invest in it. Here's a hint. Most investors opt for index exchange traded funds as their underlying asset, as the ETFs are more stable and less volatile. The charting. Charting software can be used to draw resistance and support lines, while indicators can be used to assess the price direction of the asset. There are several various chart models that help you decide where the price is going, which will be addressed further on in the following sections. Bull or bear spread. The next move is to pick either a bull or a bear call spread, depending on either resistance level or the support level. This will decide how the stock option is distributed and what happens if you want to invest in it. A resistance or support level is a certain price range or cap where the price of the commodity is difficult to meet. It's an unusual price, therefore, that the asset can achieve. Usually, if the price of the asset hits a resistance level, it will return to the original levels. The level of resistance is usually a high price limit, while the level of support is usually a low price limit. Stop losses are often put below or above the resistance level of the support. As the name implies, they are built to stop losses throughout your company. The spread of a bear call is used with resistance levels. It involves calls with the same expiration, but with different strikes attached to it. The aim of the bear call spread is to retain a bearish or neutral underlying asset. This policy relies on the viability of the premium before it withdraws. This spread takes into account that it will fall below what was the original price, and the stock will end up being lower. In other words, you're going to expect the asset's price to plateau or fall. This choice requires that you have already purchased the outlay to decide where it will go. Where it ends up is not fully understood at first, so it's a nice way to see how the payout would be when the stock option begins to fall. The most you can get out of this is the premium amount, and the most you can lose is the amount before the long call limits are set at that amount. So it's crucial to be careful when making a bear call spread. On the other side, the bull put spread is used at the level of support. It's finished with a short one and a long one, with the long one less than the short one. This helps the investor to get back some of his capital, which is lucrative when the market begins to move. It has limited risk and opportunity, and the most that an individual can receive is the premium plus whatever trend the stock decides to increase. The most you can lose with this is when the long put is capped, but most of the time there is a lower chance. With this, though, it takes a little more of a prediction as to where the stock will finally come to. You should know the figures when you start to assess where the profit margins will ultimately end up. The purpose of the bull spread is to keep the underlying asset bullish or neutral. In other words, you would expect the price of the asset to plateau or rise. It is necessary to determine at what price a spread is to be set. In most situations, the price of bear call spread is above the level of resistance. However, the price of the bull spread is set below the amount of support. Potential profit or loss. It is possible to measure the future profit or loss manually. However, brokers typically have instruments that investors can use to calculate for them. In general, the spread difference times 100 less benefit is known to be the risk exposure of the investor. Or in other terms, risk exposure is equal to the absolute value of the sell position minus buy position times 100 minus profit. In order to justify the risk, it is best to ensure that there is an adequate benefit. It is even possible to measure the danger zones and even breakpoints via the probability calculators. It is recommended that investors retain a specific probability of success and never neglect it in return for a better benefit. The spread can be put between selling and purchasing positions close to the price of the underlying asset. For example, an investor can sell a $140 call option and buy a $141 call option for a bear call spread. On the other side, the investor can also sell a $125 option and purchase a $124 option for a bull spread. A $1 loss based on option prices is not a big deal compared to the possibility of massive leveraged gains once prices go the right way. Price timing. It is essential for the investor to track price fluctuations on a daily basis. If the price of the underlying asset moves in the correct direction, the option will be permitted to expire by the holder investor. On the flip side, the investor may buy back the sold option at a loss, but keep the option. It may raise its value until it makes profit or even breaks. That's why a lot of people watch stocks like a hawk to decide when a person should buy into the right choice they have, or whether they should wait for the right moment. Missing one day could change it all. In addition, the investor will close the place by selling out every time he or she makes a profit. If you make a profit from this, it's best to get out now before the market changes. At the beginning, you can take all your wins as a chance to get out before you lose anything. And as you become more comfortable with what you're doing, you'll know when it's better to get out and when you're supposed to stay in stock. Chapter 8. Management Choices. How to keep and buy with options. Buying options does not guarantee that they will be exercised by the owner until the expiry date. There are, in truth, 3 ways to use the options. For the first, the investor will hold the option of maturity and then purchase the underlying asset at the agreed price before it expires. Investors do this because the actual market price is higher if the commodity is higher than the strike price. Second, the investor simply exercises the option at some stage before it expires. This occurs as the price of the commodity fluctuates up and down the agreed price. If the investor believes that the price will not be higher, he or she will exercise the option immediately after registering a higher price than the strike price. And at the end of the day, the investor will let the option expire. Investors do this if the price of the underlying asset continues to fall. The lack of investor experience is restricted only to the premium alternative. How to sell using options. In comparison to the holders, option writers must sell or purchase the underlying asset if the holder wishes to do so. They must purchase or sell the asset at a strike price within the agreed contract period, even if the market price of the asset is higher or lower than the agreed price. A covered call helps the writer or seller to sell the underlying asset he or she holds. If the purchaser exercises the option, the call writer must sell the asset at the agreed price. This helps the writer to earn all the advantages of the stock as well as the dividends. The only way this does not happen is when an individual has an arrangement to share the shares received within the stock. However, there is still a question of the individual not completely benefiting from this. They did get the premium and the dividend back, but they opted out of all other future price increases. So you should be patient before you do that. On the other hand, an uncovered call allows the seller to sell the asset he or she does not own at the start of the contract. The seller would lose a lot of money if the price of the underlying asset has risen sharply and the buyer chooses to exercise the option. This means that the seller has to buy the asset at a high price just to sell the loss to the purchaser. This can cause a large loss as a result of the trade, and as a result, can make an individual lose a lot of money in the investment. Observe the market. It is a common observation that traders are allowing their options to expire. This is true of traders who trade long positions. The demand needs to hit a price in order to make the option viable. If a trader wants to consider an option, he or she must consider the possibility that the market will hit a certain price. A cheap premium does not guarantee a good deal of trade. A good demand and opportunity mean that there would be a good deal of trade. You can watch the market for a certain amount of time when you are trying to purchase a stock option. See the trend, and if there's a chance to make a profit from that. If there is, then it's time to get in there. If not, then maybe it's best to sit that one out and not take the chance with it. You can watch the market by monitoring the stocks every day and seeing which ones are doing well and which ones are going to stay away. The average monthly level. Many traders tend to look at the option premium rather than the possible returns. While it is important, they tend to concentrate too much on it, thereby ignoring the risk that the demand will hit and ultimately surpass the strike price. In most cases, it is best to keep trading options easy. In order to determine whether or not the option is a successful trade, the trader should measure the average monthly range of the market. It is a number that provides a perspective on the uncertainty and the potential to hit a break-even point. The average monthly range can also be compared to other average stocks. You may see a stock that has a good trading option, but the average range is bad, and there's no chance of profit. But let's say you see one that's a little higher than the other, but you know that there's a potential for that stock. It's safer to go for the latter, because it might mean a possible rise in your own earnings, and it'll end up helping you more as a result later. Using the average monthly range. The trader wants historical prices to measure the average monthly range. If the stock is chosen as the underlying asset, historical high, medium, open, and close prices can be recovered over a certain period of time. The average monthly range requires the high and low daily values of a certain stock. The average price can easily be estimated during the cycle when the demand fluctuates between high and low of a given month. In most cases, conservative traders use open and close monthly values. The low price is subtracted from the high price for the month in order to achieve a range which is then added up and separated by months. In other terms, month 1 would equal the high price minus the low price, and then add this to month 2, which would equal the high price minus the low price, and then divide by the number of months used. Use a spreadsheet or a particular calculator or analyzer for this purpose. In general, a trader can consider doubling the length of time frame position. Then it's broken up into 2 blocks of time. Be careful though. This approach is not beneficial when the implicit uncertainty of the stock renders the premiums unwise. Smaller traders would be forced to buy out-of-the-money strike rates because they do not have enough cash. The average monthly range would tell traders to miss the trade option or use the debit spread strategy in order to get similar to the current market price. The average monthly range can be used in any industry at any time. However, it must not be used on its own. Business directional analysis can also be used. This principle only prevents traders from buying cheap, far-off premiums that give minimal returns. The debit spread. In the case of debit spread, an investor buys a higher premium option and sells a lower premium option. Let's look at an example. This trader is a bull trader, and stock F is at $10. He would need to buy call options for $9 a stock where stock F has 100 stocks. This premium would be $120. Then, he would need to write and sell call options at $11 a stock where stock F has 100 stocks. This premium should be $90. Now let's use the same example where the trader is using a bear spread. First, he would need to buy put options at $11 a stock where stock F has 100 stocks. This premium would be $120. Then he would need to write and sell put options for $9 a stock where stock F has 100 stocks. This premium would be $90. A good advantage of the debit spread is that it gives options traders restricted risks and an ability to get closer to the current market price instead of simply buying the option. The break-even points may also be lower than the purchase of an out-of-the-money option. In addition, investors limit their profits to an open-ended basis and must be satisfied with the maximum specified benefit. Under certain market conditions, such trade could have a favorable trade-off. It will also keep traders grounded on what the market will do. The promise of infinite profits is only valid if the market moves historically. This is quite rarely the case. Investors who trade for capital appreciation will not linger long if this kind of speculation is experienced. Chapter 9. Trading Strategies for Basic Options. A lot of investors and traders are losing money in options trading because they are trading options without first knowing their ins and outs. A good strategy is required to make a profit from trade. It helps an individual to optimize profits and mitigate risks. It requires only a small amount of time to learn how to make use of the power of options and their versatility. The covered call. The covered call strategy allows an investor to completely purchase the underlying asset. The investor must write and sell the call option immediately after the purchase of the same asset. The number of shares must be the same. Let's say, for example, our trader buys 100 of stock A for $10 each. He would then write and sell put options for $10 a stock where there is 100 of stock A. This premium would be $100. The profit so far would be $100. This technique is used by investors for their short-term trading practices and when they have a neutral view of the underlying asset. It is often used by traders who wish to secure their investments against any potential decrease in value. It's a decent, simple plan to start with, and if you're concerned about missing out on a potential investment, then that's the way to go. The married put. The strategy of the married put is used when investors are bullish about the price of the underlying assets. They buy the shares of the asset and then buy the same number of shares at the same time. They do this to secure their investment against future short-term losses. It's a way to cash out an investment right now so they don't have to worry about losing anything when things get rough. In a way, the scope for gains in this is infinite. The married strategy is like an insurance policy that sets the floor price in the event of a dramatic decline in the price of the asset. As an example, our trader would buy 100 of stock A at $10 each, and then he would also buy put options for $10 a stock where stock A has 100 stocks. This premium would be $100, and the cost so far would be $100. The bull call spread. The bull call spread strategy is used when investors are optimistic about a particular asset and expect the price of the underlying asset to rise moderately. They buy a call option at a certain strike price and then simultaneously write and sell a call option at a higher price. When prompted, the trader effectively buys a lower priced asset and at the same time sells a higher priced asset and thus generates profit. In order for this strategy to succeed, all call options must have the same underlying asset and the expiration month. As an example, our trader should buy call options for $10 a stock where stock B has 100 stocks. This premium would be $100. He would also write and sell call options for $13 a stock where stock B has 100 stocks. This premium would also be $100. The bear put spread. The bear put spread strategy is used when investors are wary about the price of the underlying asset. In this scenario, they expect that the price will fall further. They buy a set option at a specific price and then write and sell another set option at a lower price than their first option. When asked, the trader effectively sells the higher priced asset, then simultaneously repurchases the lower priced asset and thus generates profit as well. Like the bull call spread, this would only be effective if investors deal with the same asset on a similar expiry date. This strategy limits profit and, more importantly, loss. As an example, our trader would buy put options for $10 a stock where stock C has 100 stocks. This premium would be $100. He would then write and sell put options for $7 a stock, where stock C has 100 stocks. This premium would also be $100. The protective collar. The protective collar strategy closes benefits without the need to sell the shares of the underlying asset. Investors purchase an out-of-the-money option, then write and sell an out-of-the-money call option. Again, this only works if investors deal with the same asset. It is used by investors who have invested in a long time in the underlying asset and gained dividends from it. If the price of the asset decreases, the option owned by put will guarantee income. If the asset price increases, you'll make a profit once someone exercises your written call option. As an example, our trader is in a situation where stock D is priced at $12. He would buy a put option for $10 a stock where stock D has 100 stocks. This premium would be $100. Then he would write and sell call options for $14 a stock where stock D has 100 stocks. This premium would also be $100. Chapter 10. Common Trading Strategies. The long straddle. The long straddle strategy is mainly used to minimize losses and sustain profits. In this case, the loss is limited to the price of the options. To be successful, investors must purchase a put and call option at the same price, the exact same expiry date, and also the exact same underlying asset. They use this tactic when they feel that the price of the commodity is going to shift dramatically. However, they're not sure which path the price is going to take. As an example, our trader is in a situation where stock E is priced at $10. He would buy put options at $10 a stock where stock E has 100 stocks. The premium would be $100. He would also buy call options for $10 a stock where stock E has 100 stocks. This premium would also be $100. The long strangle. The long strangle, not to be confused with the previous strategy, is a cheaper strategy than the long straddle because the options are purchased out of the money. It is used to restrict losses to the price of the call and put options. In addition, investors use this approach when they expect that the price of the underlying asset will move dramatically. However, they don't know which path the price is going to take. To be successful, the investors purchase both a fixed put and call option with the same asset and the same expiry date, but the prices of the options are going to be different from each other. The strike price of the given put option must be below the strike price of the call option. This way, all scenarios would result in an out-of-the-money solution. As an example, our trader is in a situation where stock F is at $10. He would buy put options for $9 a stock where stock F has 100 stocks. This premium would be $100. He would then buy call options for $12 a stock where stock F has 100 stocks. This premium would also be $100. The butterfly spread. The butterfly spread technique is a variation of the spread of the bear and the spread of the bull. It also uses a range of rates. A kind of butterfly spread strategy allows investors to purchase a call option at the lowest strike price. They then immediately write and sell two call options at a higher price and another call option at the cheapest possible price. So if anyone exercises their written capacity, you exercise yours easily. You end up selling high and purchasing low, inducing benefits. It is also possible for them to buy a put option at the highest price and then immediately write and sell two put options at a lower strike price while selling the last put option at the lowest strike price. So if anyone exercises their written capacity, you exercise yours easily. Again, you end up selling high and buying low, thus causing profit again. As an example, Trader A is in a situation where stock G is priced at $10. He would buy call options for $10 a stock where stock G has 100 stocks. This premium would be $100. He would then write and sell call options for $13 a stock, $14 a stock, and $16 a stock. All of these would have stock G at 100 stocks, and the premium for all of these options would be $100. Now, Trader B is in the same situation where stock G is at $10. He would buy put options for $10 a stock where stock G has 100 stocks. This premium would be $100. He would then write and sell put options for $8 a stock, then $7 a stock, and then $5 a stock. These options would have stock G at 100 stocks each, and the premium for these options would be $100 each. The Iron Condor. The strategy of the Iron Condor is difficult to execute. It's not about new options for investors, but it takes a lot of time and practice to be successful. Investors have both a short and a long place in two kinds of strangling strategies, a bearish and a bullish direction. But no matter which way it goes, if anyone exercises your written choice, you exercise yours quickly. Done right, you end up selling high and buying low, inducing profit once again. Try not to confuse the strike prices by using this technique. You can still end up purchasing less and selling higher. For example, our trader is in a situation where stock H is priced at $10. He would start by writing and selling put options for $9 a stock where stock H has 100 stocks. This premium would be $100. He would also buy put options for $8 a stock where stock H has 100 stocks. This premium would be $100. He would also write and sell call options for $12 a stock where stock H has 100 stocks. This premium would be $100. He would also buy call options for $14 a stock where stock H has 100 stocks. This premium would be $100. The Iron Butterfly. The Iron Butterfly incorporates a short or long straddle with a strangler. It's sort of the same as the butterfly spreads. The difference, however, is that the Iron Butterfly uses both a put and a call option simultaneously. This technique limits losses and profits to a certain degree. The investor ensures that risks are reduced and that risk is restricted by the use of out-of-the-money options. As an example, our trader is in a situation where stock I is priced at $10. He would buy put options for $9 a stock where stock I has 100 stocks. This premium would be $100 and be considered an out-of-the-money option. He would also write and sell put options at $11 a stock where stock I has 100 stocks. This premium would be $100 and be considered in the money. He would also write and sell call options for $9 a stock where stock I has 100 stocks. This premium would be $100 and be considered in the money. He would also buy call options for $12 a stock where stock I has 100 stocks. This premium would be $100 and be considered an out-of-the-money option. The synthetic long call approach. This is the technique used when two strategies of spread are used for another long-term call strategy. For example, if you used a long married call with a bear call, this would be a synthetic long call. The purpose of this is to establish two long calls of the same type. It will help you generate more sales in the long run, and there are benefits to it. One thing to keep in mind, however, is to make sure that after everything, you don't do something too risky with each other. Determine if the call is worth it, and then act on it. Knowing what the risks are is how you're going to be successful with a synthetic long call. The collar call. The collar call is when you use the underlying stock along with defensive putting and selling call options. You're using the putting and selling call against the underlying stock. The aim of this is that they are out-of-the-money options, and this is equivalent to an out-of-the-money call. It is used to collect premiums on options without risking a possible long-term loss due to a fall in price or decreased risk of security. All of these option strategies will help you understand where you're going with this, and from there, you can decide where your own strategies are going. It's important to know where it's going to end up falling, because many times people don't understand the true nature of the different calls, and understanding the spreads and the possible strategies will help you better leverage the market and produce better results. Chapter 11. Avoiding Errors in Trading Options. For new traders, it's advisable to learn a variety of strategies and build on strong returns over time. There are also various things you should keep in mind before you start trading options. There are mistakes that can be made, but if you're patient and avoid the pitfalls, you're going to succeed. Don't start by buying out-of-the-money call options. Many experienced stock traders who have switched to trading options also use this strategy. Buy a call option and wait and see if it can make a profit. This is close to the buy low, sell high stock market technique. Although it can provide good profits in the trading of stock, this strategy does not reliably produce profits in the trading of options. In the long run, a dealer with options can lose a lot of money. Also, he may discover that he's not learning anything new. An out-of-the-money option is a cheap investment, since the price depends on the chance that it will hit or pass the strike price. In most instances, the likelihood is tiny. The price of the option, therefore, is also poor. Instead, a new options trader can write and sell an out-of-the-money call option on the underlying asset that he or she currently owns. When a call option is sold, the option for the writer has to sell the asset. Due to this duty, the writer will make a profit from the choice. If the investor is optimistic about the asset, he or she may make some money ready to sell the stock, even as the price rises before the option expires. Don't buy right away, but instead sell and write call options to make a profit. Observe the timing. In stock trading, it seems impossible to predict how the stock price will move. The same is true for selling options. A lot of times, fluctuation can happen overnight, before you even know about it. The options can skyrocket in price, and that's why you need to watch for any changes in the market. In general, a trader must correctly forecast the course of the price movements. They might not be correct at first, but being able to see the difference would save you so many problems, and you'll know about where the trading options are going as a result of that. However, he or she must also foresee when the price will shift in the anticipated direction. If a trader with a call option makes a mistake in one or both of the criteria, he or she will take a loss on the premium paid. If the underlying asset takes a long time to shift in the plan's direction, the profit will decline as the expiry date approaches. That's why you should know where this is going to happen and the estimated timing of the life of the stock route. See where it's going to go, and from there, you can decide where you're going to end up as a result of this. Attempt covered calls. There is actually nothing risky about selling options using the call strategy in question. The risk lies in the ownership of the underlying asset. the investor can lose a sum equal to the difference between the prevailing market price of the asset and the premium of the option. In most cases, the loss will be substantial. In writing and selling the option, there is no capital risk. There is a chance of opportunity, however, since the investor has a small upside. It is possible for the purchaser to exercise the option when the price of the underlying asset soars. As such, the seller is losing future income. On the other hand, since the underlying asset is held by the seller, the price of the asset would have risen to the selling price of the option. In the flat market, the writer or seller retains a long position when earning the option premium. If the writer wants to go out after the asset price has gone down, he or she will simply buy back the option in order to close the short place. In addition, the writer will sell the underlying assets in order to close the long place. By closing the roll, he or she can experience losses. Sales of a covered call is a low-risk and smart strategy for new options traders. An option trader can use it as he or she becomes more familiar with the trading of options. Don't use an all-purpose approach for any business situation. Flexibility in options trading enables traders and investors to participate in trading under any market conditions. They will do this if they attempt to learn other techniques. They can buy spreads on different market conditions. However, there is currently a strong business condition for using it. The long spread position has two options: the selling of a low-cost option and the purchase of a high-cost option. These options vary only in the price of the strike. A long call spread is a bullish stance, thinking the asset's price is going to rise, while a long-term spread is bearish, thinking the asset's price is going to fall. In trading a spread, the time downside of one option can be a time advantage of the other. Therefore, the timing dilemma is compensated by spreads. The downside of spreads, however, is that the investor has little upside potential. In fact, not a lot of people make big spread profits. However, the possible loss is also minimal. Strategies that could be, quote, all-purpose, may seem like a smart idea, but sometimes doing that can obscure the true potential of an investment. You can make a lot more of one form of investment than another. A lot of people don't know this at first, but it's because they end up seeing that they missed an opportunity. Try calling for suitable circumstances and know what you should do in each case. Are middlemen involved? Investors and traders must be vigilant to distribute the trade. For traders, the spread trading will cost a lot of commissions, because this kind of trading includes different trades. In the calculation for profit or loss, fees must be included in the equation. Finally, they need to know the dangers of dealing with commissioners, who would claim a share of their income. Often, a commissioner's net loss can be up to 30%, which is a lot if you look at how much you put in as a premium. Don't depend on middlemen to make a profit. You can find cheap broker sites online, but just make sure they are a legitimate place to use, because sometimes there are bogus broker sites, and that may mean an even greater loss of money as a result. Have an escape plan before the option ends. Emotions have no position in the trading of options. To be successful, traders and investors must have a strategy and commit to executing it. A successful exit strategy has upside and downside exits. It also has time frames for each exit. Getting a strategy sets out good trading trends and encourages people not to overthink it. The trader of new options must know the amount of profit that will offer enough satisfaction. The trader must also know the amount of loss that he or she is prepared to bear. The trader must know all these sums in advance. When the benefit is achieved, the place must be cleared. The same goes for the downside goal. Don't double up in order to restore past losses. In most cases, traders also find themselves in violation of their own laws. In the case of stock trading, it could be possible to double up in order to recover losses. If the price is low, a stock investor will buy more shares. However, this may not be applicable in the trading of options. Options are distinct from inventories. Thus, double up doesn't make sense in the trading of options. Time decay must always be taken into account. Leveraging is possible in the trading of options. However, it may also cause the trader to lose heavily. In order to prevent a tragedy, it is necessary to minimize losses and close the place. Be vigilant about trading illiquid options. The liquid market is perfect for options traders because it is easy to trade when active sellers and buyers are in position all the time. It also means that the next transaction is carried out at the price that is the same as the last. In general, the stock market has more liquidity than the options market because the latter provides more choices than the former. An investor who prefers to trade illiquid options can pay a higher price than the normal cost of options. In general, it is prudent to exchange open interest options at a minimum of 40 times the number of future contracts that one wishes to trade. For example, if an investor wants to exchange 10 lots, the liquidity of the investor should be at least 400 contracts. It's better to work with liquid options. Don't waste a lot of time trying to buy back the short options. The options trader must always be prepared to buy back short options. Most of the time, the trader cannot determine early because he or she does not like paying commissions. The trader may think that the contract would expire without being exercised by the purchaser. Finally, the trader might be hoping to make even a little profit from the deal. It's easier to buy back a short choice than to bear the risk of being out of the money. In general, if there is still at least 80% of the benefit from the initial option sale, the investor must buy back the short option. Failure to do so would result in losses. Dividend payout dates and earnings should be included in the options strategy. An options trader must track the dividend dates and earnings of the underlying asset. Option owners are not permitted to take advantage of dividends. If a large dividend has been declared, they will exercise a call option to purchase the underlying asset and thus collect dividends. While early assignment is difficult to monitor, since it is very unpredictable, it is better for traders to detect any imminent dividends in order not to be allocated early. In addition, the earnings season raises the price of options contracts. Any news about the underlying asset could increase the volatility of the asset. Trade options are notified after the announcement of earnings has already passed. Pending dividends would raise the probability of assignment. Any investor who still wants to trade options with an accrued dividend must learn about the ex-dividend rate. In addition, the earnings season raises the prices of options and the volatility of options. Any trader who still wants to trade options in the course of this season may want to spread by going long on one option and going short on another one. The price of the underlying asset is normally inflated during the earnings season. As such, investors should expect that option premiums will also be inflated. If assigned early, the options trader must know what to do. The options trader who writes short options must know that they can be allocated. New options traders also do not accept assignments, so when they do, the effect can be crippling. Many new option traders can panic if their short options are allocated. In most situations, it is best to remain realistic and think of better ways to get out of the situation. In order to deal with an early assignment, traders must deem it early. If they did not, they would always find themselves making unreasonable and defensive decisions. Market psychology should be considered as such. Traders can weigh the pros and cons of making a call, or make a call early. If they put in or sell a stock, they can get cash. Often, traders prefer cash now rather than waiting for expiration. This means that a given option is more used early than a call option. This might not be the case, however, if the underlying asset is set to pay dividends. If a call is made, traders will buy the underlying asset now, then wait for it to expire. In most instances, they'd rather wait. Inexperienced traders can exercise this option early if the price of the underlying asset has risen. They don't know that if they cash out early, they're wasting time premiums. Don't leg in while trading spread. A lot of traders, including the seasoned ones, learn the hard way. They take undue additional market risk. What they're meant to do is deal with a spread like a singular exchange. Both trades must be generated at the same time. A spread cannot be made without first achieving net credit or debit. This is the only way to minimize risks and to execute the plan. Take one spread at a time. Watch the market. Unnecessary risk would kill your opportunity to invest in the future and may cause a major loss if you are not careful about the risks and limitations of spread. Using index options for neutral trades. Volatility is in any stock. If the publicly listed company makes a big unexpected press release, the price of its stock will certainly be affected for a few days. However, the particular business does not have a major effect on the index. Indicated selling options is a good way to protect traders against any significant change in a specific business. It is recommended that traders make neutral trades based on major indices if they do not want to think about the effect of a single news item on the price of the underlying asset. Short spreads on indices can be lucrative if the market remains stagnant. Any sudden news on a specific business could have a drastic and rapid effect on the price of its stock. In certain cases, the stock will be exchanged as an after effect on a new horizon. Indices, on the other hand, move differently. They're less dramatic than that. More often than not, they are not affected by a single company growth. Understand the spread. A short spread can involve two positions at different strike prices. The higher price option is offered, while the lower price option is purchased. The two options must have the same criteria, except for the price. They've got to be no puts or no calls. In addition, they must have the same volume of contracts, the expiry date, and the underlying assets. The ill effects of timing may be reduced when one is sold and the other is purchased. A significant distinction between short and long spreads is that the former is structured to be efficient because there is a similar underlying asset. As such, short-term spread may be neutral to bullish, whereas short-term calls may be neutral to bearish. In addition, spreads must have at least one trading option. For brokers, this means that traders may have to pay more than one fee. Learning and mastering each spread will help you make good investment decisions. You'll know when to call or scatter, and you can decide if anything is worth investing in or not. Many times, as one starts out, they're going to call on something because of the imminent opportunity and the increases they're seeing. But if they do that and the market crashes, they'll end up losing the money they've invested. It's better to place the risk of the premium as your initial risk, and if you feel relaxed as you continue to master the spreads, then you'll be successful. Continue learning. Trading choices can be very challenging and daunting for most people. It is possible to lose money in it, particularly if the trader is the seller, because he or she has an obligation to do so if the purchaser wishes to exercise the option. On the other hand, the customer has the right, not the duty, to exercise the option before the contract expires. For most people, particularly those inexperienced, this may be a frightening effort. They may not know, however, that anything can be taught. They just have to spend time and money studying trading options before they decide to trade on their own. There is a variety of information available on trading options. All that is required is for an interested investor to find knowledge, read, and trade. Trading options can be risky. However, it is possible to minimize the risk by making the right decision. An individual needs to be informed about trading options before he or she can make a favorable decision. Part 4. Intermediate Risk Measurement. Delta, Gamma, Theta, Vega, Rho, and Lambda. Chapter 12. The different types of immediate risk management. Now that you know about the various models and how you're going to use options trading, it's time to talk about the patterns that can come up with options trading. There are various ways in which the demand flows with the shifts in the market. This is important to learn, since these words are also used when it comes to market volatility. Delta. Delta is the Greek word for transition. In options trading, this means a change in the price of the underlying asset to the corresponding change in the price derivative. It is often referred to as the hedge ratio. For example, let's assume that the price of the asset is going to be 0.8. That means if $1 of the underlying stock increases indefinitely, the call option would increase by 80 cents. Usually, the delta increases the closer the stock gets to the expiry of the option. At the end of it, it's going to hit the 1.0 delta. An example of this in the use of options trading is that if you buy a call or a put option out of the money, the option will have a delta value of 1-1. Often, in the money people go from 0.5 to -5. It's not constant, but it is related to other risk measurements and will display the rate of delta change provided by the underlying. Delta is still prone to implicit uncertainty, so it's not absolutely accurate. With this, you can calculate the net long or the net short of something along with the underlying, if you take your portfolio options into account. Gamma. Gamma gives you an idea of how much the delta shifts when the price is $1. This might tell you how secure the delta is. If there's a big gamma, that means the delta will start to shift drastically with any little step. If you have a long call or a long put, you get a positive gamma. On the other side of the coin, short stacks and calls shift the gamma to a -1. Stock never shifts because it's got 0 gamma. The gamma graph shifts much like the delta. Typically, it looks like a hill, with the top right next to the hit. Gamma is the largest number for ATM options. This means that the ATM options change the most as stock prices move. If you see how gamma varies depending on the type of option, you can see the volatility. Time passes will serve as a pull-up to the top of a gamma graph. However, as the option progresses towards expiration, the gamma tends to decrease along with the volatility. What this implies is that a positive gamma position is fine. It can produce deltas that help move the stock if it's up. But if it's negative, it will damage you, regardless of whether it's up or down. Gamma lets you look at the profit and loss chart of your position over a wide variety of stock prices. Negative gamma positions can be dangerous, so it's necessary not to mess with them. Theta. Theta indicates the time delay. It's an approximation of how much the option decreases when 1 day passes, and when there is no shift in stock or volatility. Theta indicates how much the value of the option whittles away as time goes by. It's always changing, but it shows how fast anything changes over time. Theta for the call and put at the same strike price are not the same. The difference between theta calls and the putting depends on the cost of the stock. If the cost of the stock is positive, the cost of the put is greater than the cost of the call. If the stock is negative, the theta is lower than the put. Long calls and long runs often have a negative theta. Short calls and puts have a positive theta. Stock, however, has zero theta, which means that it doesn't get diminished over time. Theta shall assess the difference in the extrinsic value of the option with more days of expiration to one with less days of expiration. Long options have negative themes, and short options have positive themes. However, if the option is constantly losing value, a short option will produce a positive theta and make money, while a long one will have the potential to cause money to be lost. As time passes, the rate of theta increases. If it's closer to the end of an option, it begins to increase in theta, but if it's further down, it falls slower. That's why the value of an option needs to be taken advantage of early, because if you don't, you're not going to get your full money for it. Theta is the largest for ATM options due to its high extrinsic value, and the theta of higher and volatile options is lower before expiry. Gamma and theta are opposites, and if anything has a high positive gamma, it's going to have a high negative theta. Gamma, in a sense, is something that gives the power to make money if the stock continues to move in a significant way. Theta, though, is what you pay for all that strength, and the longer the stock doesn't move, the more it hurts your position. The vega. Vega is not supported by a Greek letter, but it is still very important. It is an approximation of the theoretical value of an option when the volatility increases by 1%. The higher the uncertainty, the higher the option rates. Higher volatility changes the stock price, which generates a probability of the option to make money by expiration. Long calls and puts have a positive vega, leading to a change in it as time goes by. Stock doesn't have a vega because it isn't influenced by the uncertainty. Positive vega means that the option roll increases as the uncertainty increases, and decreases as the volatility increases. Vega will also rise as the uncertainty increases, and the higher options are in the money and out of the money. This means that if you have a choice that's changing a lot, it's going to have a higher vega. Rho. Rho is an approximation of how much the value of an option increases as interest rates move 1%. The call and put rho at the same strike price and the same expiration month are not comparable. It's the least used letter from the Greeks, and it's one of the options tactics that isn't used as much as the others. When the interest rates in the economy are stable, the probability of an optional position will decrease because of how low it is. Long calls and short runs have a positive rho, but short calls and long runs have a negative rho. The reason this happens is because the value of the option is built on the expense of holding the stock position. It has to do with the fact that the option is a replacement for the actual stock position. If the stock is offered for higher interest, you will have a higher rho. And if it is more costly to keep the stock position, the more expensive it is for the call option. But if the interest rate decreases, the value of the call increases, and the value of the put decreases. The fall of interest rates lowers the value of the calls and increases the value of investments. Lambda. Lambda is the percentage difference in the price of an option contract relative to the percentage change in the underlying price of that option. Lambda is one of the Greeks used in the study of derivatives for a percentage point change in its implicit volatility. If the lambda is high, the price of the option would be more susceptible to minor shifts in volatility. When the lambda is tiny, shifts in volatility would have less effect on the valuation of the option. Lambda is a byproduct of delta because it adjusts the ratio of the underlying price to the option price. Since there is a clear connection with the delta and not with the heading, it is not commonly used. Traders tend to use delta because it shows them their risk profile directly. Lambda is useful to assist with the sale of options to customers. The value of the lambda is around 5 to 15. It is adaptive to the maturation of options, albeit very significantly out of the money options. Examples of how this is used. The best way to grasp anything of this nature is to see how it is used in the field of options trading, in the form of examples. There are several examples above, but this section will show only a few ways in which trading options can be used and how they impact the usage of various options and what happens when you call and share. Let's take an example of stock X for the delta. Let's assume that the value of X is $3 and the delta is $4. The price of the stock is $48. Now, let's assume that the stock is going up $1 to $49. If that happens, the value is going to increase to $3.40. And if it falls, it's going to be $2.60. This can be seen in the same way as other figures, such as if the stock is worth $4 and the delta is -5, with the stock being priced at $48. Let's say that the stock is rising. Instead of the option rising, it's going to fall to $3.50. But if it's going to increase for any reason, it'll go up to $4.50. It's an odd way if it's going to fall, and changes will happen, even though the stock price doesn't change. For gamma, an example of this is that if you have stock X, you have a delta of 0.40 for a call, but the put has a -5 with a price of $48. The gamma for both of them is 0.07. Now if it moves, it's going to be the gamma plus the price increase and then the deltas. It moves the same way with a call and a put, so you can see how the stock is going to shift as a result of this. For the gamma position, the position delta shifts as the stock prices jump by $1. For theta, and an example of this is how the stock can decrease over time. For example, let's assume we have a stock priced at $4. Let's offer this stock with an expiration of 20 days and a theta of -15. This stock is worth $4.75 and has 80 days before it expires with a theta at -0.05. Now let's presume that the day passes and the market price doesn't change and there's no implicit change in the option's volatility. At the end of the day, the put is going to drop to $3.85, while the other one is still going to be $4.70. This means that the stock that has less time will expire and will end up losing less money at first, but then it will get bigger as time goes on. The theta location will calculate the shift value as the day passes. It is determined much like the delta, but only using the value of 1 point for an option contract. Typically, they're about $100, but they can be different because of the way the stock splits. Each theta option is measured in a position multiplied by the number of contracts and the value of 1 point for an option contract, and then added together. An example of this can be seen in Vega's call. It may have a value of $2 and a vega of plus 0.20 with a stock volatility of 30%. If the uncertainty increases to 31%, the value will rise to $2.20. Now let's assume that for some reason, the vega will fall to 29%. The value of the stock will fall to $1.80. The vega is calculated by a shift of 1%. The theta location is determined in the same way. The vega is determined by multiplying the number of contracts and the dollar value of 1 point for each option contract, and it's added together. In Rho's case, this can be seen in how you treat the stock. Let's say you think the stock is going to grow, so you get 100 shares for $4,800. Or you could get 2 calls for $400. Now let's assume that there's a plus 0.8 position delta near the 100 position delta. You'd have to pay about 12 times the amount spent on options that you'd spend on cash, which means you'd have to borrow money on interest to even get the stock. And that's typically measured in the value of the options. Now let's assume that there is a stock that has 50 calls with a value of $2 and a lambda value of 0.2, with a stock of $48 and an interest rate of 5%. Now, if it rises by 1%, the value will only rise to $2.02. And if it falls, it will fall to $1.98. Both of these terms are what will help you in trade-in options. In the next section, we will look at the different ways in which each of these different option techniques can be used and how they influence the way in which risk management is generated. They're very important to know, and it's something that every trader needs to know about. Part 5. Intermediate Risk Management for Options Trading. Chapter 13. Basic Techniques for Risk Management. Risk management is very relevant for traders of options. It's something any trader of options should know, because if you don't, it can cause issues later on. This chapter will help analyze some of the best risk management techniques for active traders to help avoid snags when it comes to trading options. Plus, once you get these down, you can use them to protect your capital. They're going to save you a lot of trouble now and later. Why plan? You may be wondering why you need to learn this. First of all, it's an integral aspect of trading options that is forgotten by a lot of people. There are lots of option traders who go into it, do some trades, and make huge profits from it. That's fine, but you can lose anything in 2 poor trades if you're not using proper risk management over time. These easy strategies secure your money, and they are something every trader should know about. Trade preparation. For everything in your life, the first thing you need to do is prepare. From battles to what you're going to do later, planning and preparation are how you get to the top. It's the preparation that will get you places, and good traders prepare their trades before any sort of trading begins. Planning ahead is the difference between failure and defeat. Stop loss and take profit are 2 ways to help you prepare ahead in trading options. The trader knows the price that they are willing to pay to sell options, and they calculate the return against the likelihood that the stock will meet the estimated amount. If they have enough of it, they're going to sell it. Unsuccessful traders don't really look at what they're trading, or have a strategy when they're selling in order to make a profit. They don't know how the options market is going to move, and as a result, they're like players with the options they have. They may have an unfortunate streak, and then feelings may take over. Emotions are not a part of trading options. They are just preparation and strategy. If losses arise, people hang on and decide that they want their money back, but then they continue to make the same mistakes. If you prepare before you deal, you'll end up at the top of the trade. Stop loss and take profit clarified. You've seen what those 2 terms are, so you should know what they mean. It's important to have a firm grasp of this because, as a trader, it can be the deciding factor between making a sale and making a profit and not being able to do so. Stop loss is the price at which the seller sells a stock and takes a trade loss. This happens when the trade doesn't happen as they had hoped. They can help discourage the coming back mindset and minimize losses before it gets to work. For example, if the stock breaks before the stage, the trader will sell it as soon as possible in order to avoid losing anything. Take profit is the exact price that the seller would sell the stock in order to make a profit. It's when the option hits the price that they want. It is when, given the risks, the upside is reduced. If the stock moves upward at a resistance stage, the trader's options may sell it before the consultation takes place. Take profit is the exact price that the seller would sell the stock in order to make a profit. It's when the option hits the price they want. It is when, given the risks, the upside is reduced. How to set stop-loss points. There are times you need to look and set up to avoid losses and make money. This is generally achieved with a scientific study of formulas. But you can also look at the fundamental analysis as well. For example, if a trader is keeping a stock ahead of the earnings as enthusiasm grows, you might want to sell it before the market learns about it. This will keep more of them from investing in it, and they'll get a return from it before it gets too risky. Another way to do this is by shifting averages. This is simple to quantify, and the demand can be tracked. Typically, they are achieved by a certain amount of timed averages. You can place this on the stock chart and decide when the price has responded, and when it is at the support or resistance level. You can weigh this too, and set up trade lines. They can be rendered by connecting the peaks and valleys that occurred at a large volume. These levels react to the tram lines that generate a high volume. However, you should make sure that this is used in the long term for volatile stocks to avoid price fluctuations that trigger a stop loss. You should change the averages to the price ranges you want, and the longer the targets should reduce the amount of signals you want. You should also adapt to the fluctuations of the market. If the market doesn't shift, the stop-loss point can be tightened up. You can also look at main time intervals in order to maximize the stock price. Calculation of returns. Another way to help set up a stop and take point is to help you measure your anticipated return. It's necessary because you can think at a pace instead of rationalizing it. It will also provide you with a structured way of comparing transactions and selling at the most profitable moment. This will give you a chance to see what the anticipated return will be. It will help you decide when to trade, along with the possibility of gain or loss, along with helping you make an informed guess. These risk management techniques can help keep things from getting worse. It's important to know this, and it's something every investor should take in before they start trading in options. This reduces the risk and lets you get to the top. Chapter 14. 9 Options Trading Risk Strategies. Taking part in trading stocks, there are some risk management options that will help you invest more and make things better for you. This chapter will cover 9 unique items to look out for when trading options and why each of these 9 options is relevant for trading options. You should be able to use this to ensure accuracy in the trading of options, along with tremendous performance. Allocation flow downstream. The first definition is the division of money. You're expected to make sure that you're not throwing everything into one thing. You should make sure that you don't place your entire investment portfolio in equities, but also in shares, real estate, and commodities. You should also strive to ensure that the diversification also extends to groups. Some people start thinking that they're just going to put their options into equities like Apple or Google. However, if you don't put it elsewhere, it will just make your portfolio overweight in that one region. You should also make sure that this does not interfere with each other as though you own both stocks and mutual funds. You should look at the business and what it holds before you invest in it, because you might end up investing too much in one place. The explanation why you should take care of this and make sure that you effectively distribute it is because the more diverse the portfolio ensures that there will be fewer swings or losses in the event of uncertainty. In recent years, however, the downturns can be linked, so make sure that if you're spending, you don't place everything in just one market. If you put everything in real estate, it might end up ruining you. such is the case of several investors during the 2008 housing bubble burst. The value of variation. Options that are diversified will potentially make a difference in the portfolio. Options, particularly those that are volatile, can be seen as a class. They can even be used to shield you as a whole. You can use ETFs to assist with this, and it can be useful when it comes to hedges. Getting a different portfolio can help you avoid something from happening, and it can also demonstrate that you're in a strong place if things do go wrong. Watching total risk capital. You also need to take care of the total risk money. If you are trading options, you should be careful to raise that total risk capital by more than 15 or 20%. This is because if you let it go, you're putting yourself at risk, and you may have too much on the table. You'll also need to prepare if a stop loss happens to you. You may lose more of your capital than you planned. That's why you need to make sure that your portfolio only has so much, and if it goes beyond, behaving accordingly. Watch option account. If you have an option account, you need to watch how much you have on the market. You should make sure that at any moment, no more than 50% is on the market. It's risky to even get 50% on the market, so maybe it's better to have less than that. Observe singularities. For a single option, make sure that it does not reflect more than 5% of the portfolio of options on the risk side. If that place begins to struggle, it won't hurt you if that's the number. This is because it can typically go down to about 2.5%, which is just a 50% total loss. It's easier to make sure you're not putting too much into one field than depending on one way to save it all. Trade depending on your comfortability. The problem with a lot of inexperienced traders is that they don't trade with what they're comfortable with. Many credit products are difficult to grasp, but the main problem at hand is that they are dual leveraged products. Many of those who are beginning are not happy with their construction and actions. You should make sure you know how to deal with the product, because if you don't know enough about it, you won't get anywhere with it. It will save you if you stick to this risk management approach, and if you combine it with learning, it will make the ability to trade options even easier. Manage your cash. Managing money is crucial to this. You've only got a certain amount to use, so you've got to keep a hold of it in order to prevent it from being lost forever. The easiest thing to do is position size, which is when you decide how much you want to trade in some options. By doing this, you can decide how much you want to spend, and how much of a percentage you're going to put into something. You can only use a small amount so that you don't depend on a single outcome. Some trades can turn out to be bad, but if you don't get it right and just put a certain amount on it, you'll be able to determine how much you're going to put in and how bad the future risks will be. Managing orders. If you want to handle the risk in an easy but efficient way, you can use a variety of options to position your order. In addition to the 4 key order categories, you can position various orders of options to help with risk management. You can look at what's going to help you because sometimes it will help keep you from selling at a cheaper price. There are orders that you can automatically lock in benefit to reduce losses. For example, if you use a limit stop order, it can be regulated when you exit the place. This will help to avoid situations where you'll lose out on gains by keeping a roll too long, or prevent any significant losses because you didn't back out quickly enough. Watching options spreads. Watching the options spreads will give you a good idea of how the stock is going to shift. For example, if you bought a phone call on a stock and then wrote cheaper calls on the same stock out of the money, that ends up being a bull call spread. You should use these spreads to better control your risks. You can reduce the cost of joining a position, along with reducing how much you choose to use, and this can help to reduce the overall risk. These spreads can also help with short positions, and as explained earlier, they're all described to you. You can use them to decide when to exit and even how the industry trend is going. This will avoid losses from happening, and it will save you in the long run. These spreads are important to those working on trying to reduce the risks of different options trading, and they are important to know. Trading options may seem like a huge, complicated matter, but restricting options to trading risks is how you put yourself in a place where you know what's going to come out of it and what's going to happen. Doing so will help reduce losses and help increase the profits you want in your options trading. Part 6. Options Trading Secrets and Recovering from Losses. Chapter 15. 10 Option Trading Secrets from the Experts. When you start trading options, you'll feel like you're bombarded with a lot of details, which is real. But if you're going to have the drive right from the start to the stop, you've got to have a few tricks up your sleeve to take advantage of that. And at the end of the day, the advantages or leverages are the only thing that can get you the money you want. Most people would think that there really is some sort of secret that keeps rich people rich and doesn't let other traders win. But that can't be further from the truth. In fact, all the secrets you're going to read here are common sense, and they all depend on your ability to understand and apply certain things. The greatest secret to all, yes, even life, is persistence and self-discipline. You want to make sure that with every trade, you learn new things and that your knowledge of a specific topic is continuously growing. You will be tested in this way, but in a tough and constructive way. Number 1. Don't ever think about dollar amounts. Think in fixed percentage terms. This is one of the big errors that even middle traders make. They prefer to believe, in terms of dollar amounts, that any exchange will be either lucrative or risky. When you think of making trades in dollar amounts, you'll think you want to make at least $2 for every $1 you have in your trading account. And let's presume that you've got a $5,000 account. Common sense says that you already have $2 on the line, which can go both ways. It can either turn into a profit or it can turn into a loss. And that includes the original $1 as well. So you plan to put $500 on the line and make a $2 profit for every $1. Simple calculation says that it will only take 10 bad trades for you to run out of liquidity. On the other hand, if you think of these things in terms of a set number, you would be stopping yourself from taking a lot of risk. So if you plan to gamble 3% of your overall capital to make a profit, you're only going to risk $150 per trade. So stop yourself from taking big risks by thinking in terms of a set number, not in dollar amounts. Number 2. Hedge, hedge, and hedge. Hedging is one of the most important aspects of the trading of options. Remember, for example, that you are buying an opposing position and that you are still retaining your current position. After that purchase, if you think the stock is going to increase, you can easily buy 10 call options to make a profit. But what if the world is playing a game against you and the stock isn't going any higher? You'll end up spending the money as the options come to an end. But with hedging, you can turn the loss into benefit by buying 5 options when things are going against you. So even if things go really wrong for you, you can still make a profit out of it. There is another hedging strategy called a covered call. You own the underlying stock in this strategy, and you sell a call to that stock. When you're selling the call, you accept that you're going to cover the sale of the stock at the strike price of the option. This means that the risk on your capital is transformed to an advantage, which means that you lose less money when things hit the fan. One thing you should know for any trade is that you should use everything in your arsenal and have as much leverage as you can to make a profit. Make the most of the various strategies and choices you have. Plus, exploit the protection you get from trading options. Number 3. There is never a policy of all purpose. Traders and investors who pursue a particular strategy whatever the market conditions, are typically the ones who get scared of the stock market. They keep investing and don't sell unless there's a big shift in the fundamentals. This is totally wrong if you want to make a fast profit and escape long-term risk. Also, there's never an all-purpose approach that some traders use. In this situation, you need to go with the flow and adjust to the market conditions. In addition, let the market conditions lead you in the right direction. More often than not, you're going to make a profit. This means that you can never miss the opportunity to purchase calls, spreads, and mails. But of course, before you buy all of that, you should know what's going on in the markets. This is where the analysis will come into play. Number 4. Still have a plan to leave. You're still expected to be ahead of the curve and have an escape plan in place. It doesn't matter whether you're winning or losing. A strong escape plan will help you reduce your losses when things go south. Plus, it also lets you get rid of some of the trades that keep sucking in your earnings. On the other hand, the exit strategy also protects you from losing profits in the future. This rule is universal for any form of investment. You want to make sure that you can get out of the situation with a smile and a healthy amount of money. Number 5. Study doubling. It's tempting to double your income when you know that trade is going according to your schedule. But then bad things are going to happen, and that's why you want to make sure you're ahead of the game. You find out the patterns, and then you play on that to keep yourself from losing. Make sure you know the pattern is strong, and you can trust it to carry your money. Even after that, you're expected to have an escape plan all in place to save yourself when things do go south. Don't ever play catch-up when it comes to trading options, because you're going to end up losing your account. It may be easy to open a new account for trading options, but it's not worth the task. You should try to stay low and learn the ropes when you start, and then gradually raise the risk you're going to take. And over time, you're going to be able to enjoy a trading lifestyle. Number 6. Never start trading out of the money call options. On the surface, it could seem like the right thing to do, but it's more of a gamble and less of a transaction. It feels right to buy low and sell big, because that's the business trading mindset that we all have. But you see, there's a lot more to trading options than just buying low and selling high. There are a lot of other leverages you can use to raise the profits consistently. Out-of-the-money calls is one of the biggest errors that newbie trading options make. They don't know it's one of the hardest ways to make money on a regular basis. So what's so bad about buying a call? It takes a lot of research and toughness to call the direction in which the stock will move. Not only do you have to be right about the direction, you also have to be right about the timing of that direction. If something goes against that, you're going to lose the premium you paid for that option. And when things go south, every day the stock doesn't shift in the direction you want, your choice will evaporate just by sitting under the sun. It'll be waiting for the expiration date every day, and there's nothing you can do. What you should do to have an educated trade in this situation is to sell an out-of-the-money call to a stock that you already own. This is called the covered call in terms of option trading. What you actually agree to is that if the price of the strike is higher than the current price of the stock, and if the price of the stock meets or exceeds the price of the strike within the time specified above, you'll have no obligation to sell the stock to the purchaser if they call it. When you do this, you're going to make some money by selling your out-of-the-money call. And if the stock price hits the strike price, you're going to make even more money. Selling the out-of-the-money call reduces the risk and puts the stock itself at risk. This means that even though the risk is substantial, you're not going to lose as much as you would if you hadn't sold the out-of-the-money call. But if the stock price doesn't hit the strike price, and if the market stays flat, you're not going to lose anything, and you're also going to earn a premium for the call sale. Eventually, you're going to have your long stock spot until you sold the out-of-the-money call. On the other hand, if you get acquainted with the world of options trading by selling covered calls, you can learn the ropes much quicker and without losing a lot of money. Selling covered calls is considered a good strategy because the cost is very low, though you can still make a significant amount of money. Plus, you can also learn how the price of options responds to minor changes in the market and how the price decays over time. Number 7. Trading illiquid options. Liquidity is critical if you want to make fast money. Liquidity means that the market is primed and that it already has committed buyers and sellers at all times. The statistical definition of liquidity will be the likelihood that the next transaction will be performed at a price equivalent to the last. In comparison to trading options, stock markets are typically more liquid. This is because stock traders are selling just one form of stock, although on the other hand, options traders have a plethora of contracts they can choose from. For example, only one type of IBM stock would have to be purchased by the stock trader. That's it. The options trader, on the other hand, would have a lot of expiry dates and a bucket load of strike rates to choose from. This means that the market for trading options is not as liquid as the stock market. Yet, IBM has little to do with the liquidity of the options market or the stock market. Take another example of an organization that is smaller than IBM. Superior Processor stocks will be even more inactive relative to IBM, and options will be even more inactive. Superior Processors is a fictional processor manufacturing company that promises the world can use quantum processors in its daily life within 5 years. However, because they are only a small business, their stocks are exchanged only once a week, and only on appointment. When stocks are inactive, the offer and ask price of the options will be artificially large. For example, if the bid-ask spread is 30 cents, bid equals $1.90 and ask equals $2.20, and if you purchase a $2.20 contract, you will have a loss position right off the bat. Plus, you will also have a lot of issues to contend with due to the lack of liquidity on the market for that particular stock. The best thing you can do for yourself when you start trading options is to trade liquid options. Not only can this help you save a lot of time, money, and stress, but it will also help you learn a lot more in a short time. Number 8. Don't wait too long to buy back your short options. It doesn't matter if you're just hoping that you'll be able to squeeze the tiny benefit out of the trade, or if you're just waiting for the contract to expire worthless. You're never expected to wait too long to buy back your short choices. Buying short options early is much easier than dwelling on why you made the same mistake again. If you think that a trade is going to get out of hand, and you can buy back your short option to reduce the risk and bring an end to the profit trading, then do that immediately. It's going to be worth the extra money you're paying. For example, if you sold a $1 option and its value is now down to 20 cents, you wouldn't sell it because it's not worth it. Also, you're not allowed to worry about scratching out a few cents of a profit from that trade. The only thing you can do to save your 80% from going down is to buy back the short option right away. And it's only a matter of time before the short alternative comes around like karma and bites you, only because you've been waiting so long to buy it back. Number 9. Never forget to include the dates of earnings or dividend payments in your option strategy. You want to know when the dividend is coming from the underlying stock because, as an options owner, you have no right to a dividend from the stock. In order to obtain a dividend, one must exercise the contract of the preference and purchase the underlying stock. Keeping track of these dates will work to your benefit and avoid the risks of early assignment. You'll see in the next secret that the given thing is a random thing that happens, and it's a threat to options traders. The imminent dividends are one of the few causes that you can recognize and prevent in order to minimize the chances of being allocated. If you think about this in real-world situations, you'll know that option contracts get more value during the earning season. Option plans are almost like insurance. If you try to get home insurance in Florida, and your weather forecast says there's a hurricane coming your way, then it's clear the insurance is going to be more costly compared to other situations. It's the same for option contracts. They're getting costly during the earning season. If you like trading high volatility stocks, the earning season would be a perfect time to do so. But you should still be thinking that there are going to be a lot of ups and downs, and you're going to have to build a lot of leverage to remain above the water. To be on the safe side as a novice, you want to trade options after the earnings have been released and the demand has been absorbed. If you want to experience the volatility and learn, you can stay safe by buying one choice and selling the other. This is going to build a spread. How is this going to help you? The price of the option you are purchasing is likely to be inflated due to the season of earnings. But thanks to the season, the price of the option you will be selling will also be inflated. Number 10. Know what to do when you are assigned early. Many of the newbies panic when allocated, and the choices they make during that period may be devastating to their plan. It's always safer to know that if you're selling options, there's a risk you could be allocated. This can happen particularly if you have a multi-leg strategy where you're dealing with both long and short spreads. You run a long call spread and, for example, the higher strike short option is allocated. Most beginners, and even intermediate traders, will panic and try to get themselves out of the situation by exercising a lower strike long option to deliver the stock. But in the long term, that's not the best decision you're going to make. The only thing you can do in this case is to sell a long way in the open market. This will help you to capture the value of the premium and also the value of the option. You can then use it to buy the underlying stock. And when you have the stock, you can deliver the stock to the option holder at a higher strike price. This is hardly going to influence your plan, but in reality, it's going to force you to take action to make sure you get a profit out of every trade. The only thing you can do in this case is to sell a long way in the open markets. This will help you to capture the value of the premium and also the value of the option. You can then use it to buy the underlying stock. When you have the stock, you can deliver the stock to the option holder at a higher strike price. This is hardly going to influence your plan. In reality, it's going to force you to take action to make sure you get profit out of every trade. Being allocated is one of those business moments that seems unfair, and that the world is playing a game with you. You're not going to have any explanation why that happened. It just happens, and you've got to deal with it in the best way possible. The best thing you can do to stop being assigned is to make an early call if a dividend is pending. But we all know it's not that easy. As I said, the best defense against early assignment is to include the dates of the dividends and earnings in your plan before you start trading, or else it's going to drive you to make choices that you won't like in the future. When you take those dates into account, you'll ask yourself, which options to exercise early, put, or call. Exercising a fixed option means you're going to sell the stock and get the cash right now. But before you do so, you have to ask yourself whether you want the cash right now or on the expiry date. Some traders are going to want currency, while others will want it later. This ensures that put options are usually exercised earlier than calls, unless, of course, the stock pays a dividend. When you want to make a call, this means that the trader is willing to invest the cash right now and wants to purchase the underlying stock. But traders are typically more likely to invest the cash later in time, and this is when less experienced traders make the mistake of pulling the trigger too early. They're leaving the time premium on the table by doing so. Chapter 16. How to recover when the trade turns against you. It's all right and good when you make money and win every exchange. Things are going according to your strategies, and you think you've got this business option under your belt. But all of a sudden, you're in a position to run away from a trade because you want to stop too much loss. How did you get here? How are you coping with the loss? Recovering is a vital method to ensure that your psychology is straight and that you learn from your mistakes. But first of all, you want to make sure that you've learned enough knowledge to help you learn from other mistakes. In this part, we're going to concentrate on how to rebound from your losses and why it's important to have a clear mind and keep things straightforward, particularly when they're rough. You ask yourself, how can I restore my account and reduce the percentage of losses I've suffered? When you start losing trades, you start hoping that there's a sudden step that you should take to get rid of all of that and get back to winning trades and making money you like. But this is a lethal error. You can never make sudden adjustments to the way you deal because you're going to lose a lot of money in the long run. You should understand that the market does not have a plot against you. There's no way you can restore your account overnight. This is how you slowly and gradually repair your trading account so that you've learned all along the way and become a successful, stronger trader. Number 1. Don't trade with real money. This might sound nuts and unproductive, but you've got to stop it right now. This would keep you from wasting any more money because of the mistakes you've made in the habit. Give yourself a break to calm down and realize that you've lost a lot of company. One of the reasons I'm telling you to stop trading is that you might be trading in vengeance, which is the fastest way to lose all the money you've got. Number 2. Clear your head. Now that you've stopped trading, use this time to clear your mind and decide the items that cost you your money. When you find out those things, you'll notice that you actually feel stronger, because now you know that you can close the distance. For certain individuals, the loss will have a psychological impact, and if you're one of those, then you want to wait to make sure you get back to the right way of thinking before you get back to trading. When trading, you want to be calm and positive. But stop becoming overconfident and unrealistic, because that's what ends up with losses. Number 3. Demo trading. Now that you've learned stuff that results in losses, you can test various techniques and ideas in the demo account to make sure they're working in real life. Use this time to really pin it down and know exactly what steps to take in various circumstances to make a profit and win almost any trade. It's like a rehearsal session, so make sure you're going to last these hours and appreciate that you're doing it, because that's going to keep you from losing thousands of dollars in real-life trades. Demo trading will also help get you in the right way of thinking, and when you start winning trades in your demo accounts, you will increase your confidence when you're trading live. When you see that you're doing incredibly well in your trial account and that you've corrected your errors, it's time to get back to real trading. Number 4. Start live trading. Now you know exactly how to deal with various circumstances and how to deal with things. Now is the time to know that you put in the hours and that you were a better investor because of the losses you suffered earlier. Never let your past experiences determine your acts in live trading. And if you find yourself making the same errors, then you need to repeat steps 2 and 3 again in order to get it right. Remember that this is going to happen to the best of us. This is a normal occurrence, and you shouldn't feel any guilt in saying that you're taking some time off trading because you're not in the right mind. A professional trader can realize that your thought has a lot to do with what you get out of any trade. Number 5. Handle risk discipline. When you're trading live, there will be moments when you think it's worth taking a big risk. But then you know it wasn't, and you're going to get rattled by the defeat. You should know that your self-esteem is not your net worth. You should be able to cope with the losses in a constructive way. Again, as I said before, your thought plays a very important role in how your next trade is going to go. When you're trading live, there will be moments when you think it's worth taking a big risk. But then you know it wasn't, and you're going to get rattled by the defeat. You should know that your self-esteem is not your net worth. You should be able to cope with the losses in a constructive way. Again, as I said before, your thought plays a very important role in how your next trade is going to go. Either you can let the trade gods determine where you're going to end up, or you can take control and pave your own way. When you learn to deal with losses in a constructive way, you can immediately become a professional trader. Amateur traders become emotional when they lose, and the emotion gets the better of them. Professional traders discipline themselves and persuade themselves that this happens often, and their choice is whether to lose the next trade because of it, or win it and recover from the loss. Finally, you can never attempt to make up for past losses by doubling your trades. You can find yourself in that position a lot of times as a beginner. You're going to be tempted to keep trading the same option you started with and keep doubling it because you're winning it. You start to believe that the whole market is incorrect and you just know what's going on. You think you liked the stock when it was at 80, and you certainly love it when it was at 50. Yet common sense doesn't work in these situations because you're already thinking about your feelings. Discipline is very important in these situations, or else you lose your income.